We're speaking to our next guest about all the events happening throughout Europe, what it means for bondholders. Joining us now is Tran, Deputy Managing Director of the Institute of International Finance. This is a Washington-based banking trade group. Now, the IIF did negotiate the swap deal for Greek government debt that included that 50% haircut for investors. They do, however, represent the bondholders in these situations. Welcome, Hung. Nice to have you here on Street Smart. How do the latest headlines we are seeing out of Greece impact that 50% write-down that was negotiated amongst the bondholders and Greece?
We do not expect the development in Athens impact the agreement reached on October 26, 27 in Brussels. We think that the program will go forward, and we have been in contact with the Greek authorities and Euro area officials in the past week to further discussion on the details of the exchange program. And I think that if the situation in Athens is clarified later today and tomorrow, and if there's a government capable of marshalling more consensus among Greek society to support reform, that could be a move in the right direction.
Hung, do you worry, though, with every day that passes and no resolution in Greece, do you worry that that 50% haircut could be in jeopardy, that you could ultimately be looking at something like 70% or 80%?
Of course, the delay in implementing the tough reform will be very risky and will lead to the situation deteriorating further the longer we wait. However, 50% nominal haircut is a very significant and I could say unprecedented forgiveness of the indebtedness of a sovereign debtor. It is almost $100 billion euro, or about 55% of Greek's GDP. So I do not expect any further nominal haircut to be accepted by private sector investors in view of the fact that leaders in Europe, in the ECB and also in Greece would like to have this as a voluntary approach. Deeper haircut would not be consistent with a voluntary approach.
Hung, are you watching events in Italy closely at this stage? We were talking about the bond yields there a little bit earlier, and they suggest, because there was a pattern that was followed by Greece, Ireland, and Portugal before all three countries actually needed a rescue or a bailout. Do you worry that Italy is next and that Greece perhaps maybe set the wrong precedent in terms of a haircut?
Yes, I think that the deterioration of the sovereign bond market for Italy is very worrisome because of the much larger outstanding volume of Italian government bonds, 1.6 trillion euro compared with others. I think that Italy, as compared to Greece, has the economic means and the capability to deal with the problem only if the political leadership has the credibility and the resolve to implement reform and implement fiscal consolidation the way that the Prime Minister had promised earlier but failed to follow through.
Now, as it relates to the bondholders, when these haircuts are announced, is it sort of mandatory? Are you discussing with them the necessity to actually do the write-down immediately or mark to market almost immediately upon that agreement?
Well, there are two different things. One is the forgiveness upfront, meaning the nominal reduction of 50% of Greek government bonds in private sector investor hands. That will happen the moment the exchange is implemented. And to cushion for that and to help investors deal with the net present value losses, the European authorities agreed to put on the table 30 billion euro as a facilitator and to facilitate the deal.
Explain how that works.
Well, we can use that money to provide credit enhancement to the new Greek government bonds offer in exchange of the deal. In other words, you write off 50% of the nominal value of the existing bonds, and then you have in exchange 50% remaining in new Greek bonds whose principal could be collateralized or credit enhanced by the 30 billion euro put forward by the authorities.
Hung, as it relates to just the bond markets and what's acceptable going forward, when do you think that the bond markets throughout Europe will normalize, or when will bondholders trust these countries enough to go back in and actually buy their debt at auctions?
I think that it will need at least 2 quarters or so of steady performance by the crisis country, that is Greece, but also Portugal and Ireland, and also in this instance Italy, to show that they are able to put their house in order in the sense of implement very significant economic reform to make their economy more flexible and able to grow out of the crisis. And after some good, decent performance both by the economy and by the fiscal development, I think that confidence can be restored, but not on before that.
All right, Hung, we're going to leave it there. We do appreciate you, though, joining us with the sort of perspective from the bondholders, one that we're not easily able to get on a daily basis as we've gone through these events in Europe. Thanks so much. That was Hung Tran of the Institute of International Finance joining us live from our D.C. bureau. We'll come